The great debate in this room and for most investors around the world is where we are in the cycle of peak inflation, peak Fed, and is there any sign of a pivot? Over the weekend on Wall Street Week, you said that you thought that the bulk of the big moves from the Federal Reserve were behind us. I'm just wondering what that means in terms of a pause from the Fed. Let's set the stage, first of all, in what you mean by the bulk of the big moves are behind us.
If you looked at option markets 12 months ago or 18 months ago, they were saying that the odds that interest rates would be where they are today were in the range of 4 in 1,000. So we've had a massive shock relative to what markets were expecting. I was saying a year ago that I thought inflation was going to be much more serious than the consensus, and that the kind of judgment embodied in the Fed's dot plots was way, way off. I don't have any similar sense today that there's going to be a massive shock relative to the consensus. We have seen a very substantial upward move in interest rates. My read is that with respect to the prevailing market consensus, which points towards rates peaking at 5, I think it's more likely that the ultimate figure will end up significantly higher than that it will end up significantly lower. But there's very substantial uncertainty. My best guess would be that there's going to be a bit more momentum in inflation than is now priced in. I think people have a tendency to always pick out the factors in the figures at any moment that are pointing towards transitory inflation, that are pointing towards an acceleration in inflation. To take just one example, the way in which the PCE deflator that the Fed focuses on, their preferred price index, is constructed means that automatically when markets go down, financial services costs go down, and that shows up as deflation because 40 basis points or whatever the asset management fee is shows up as a lower dollar price, and one doesn't expect that to continue as rapidly over the next year as it has over the last year. So my sense is that there's going to be a bit more inflation momentum than is priced in, and therefore my guess is that rates will end up somewhat higher than is now priced in, but not the kind of massive shock that we've seen in the last year.
So what happens if we cast our view forward and we go into next year? I wanted to put it to you that the only way is that not that the Fed blinks, but that the government blinks, because you need to create, unfortunately, higher unemployment than we have to deliver a disinflationary environment or to break the back of inflation. So how far do we see unemployment rising to deliver a disinflationary pulse?
So, I have said many times that unfortunately I suspect that what Samuel Johnson said about second marriage is true of soft landings. They represent the triumph of hope over experience. And so I don't think we are likely to succeed in achieving substantial disinflation without a meaningful increase in economic slack as a concomitant of the disinflationary policies. The latest dot plot's judgment that inflation will come down to 2 with unemployment peaking at 4.5 is a possibility, but it wouldn't be my central tendency in terms of what I would expect.
But to take,
I don't think there's anything that requires unemployment to look like it did after the great financial crisis or as it did during the massive Volcker disinflation of 1980 to 1982. I think the kind of recession that the economy suffered after the NASDAQ bubble broke, or the kind of recession that it suffered in wake of the various strains in the post-1990 period, is probably more indicative, and that would point to an unemployment rate perhaps approaching 6. There's a proposition in U.S. macroeconomics known as Salm's rule, after the former Federal Reserve economist Claudia Salm, which suggests that when the unemployment rate has risen by 0.5%, historically it's risen by more than 2%. That would support a similar kind of conclusion.